Welcome back to Investing Talk Podcast.
Today we're looking at Western Digital.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Western Digital, for a long time, the market has seen them as this deeply cyclical, almost a commodity player in storage.
Right, boom and bust.
Exactly. But what we're seeing now, it isn't just a recovery. It feels more like a powerful financial inflection point. And it's being driven by a huge structural shift.
And that would be the demand for AI-related storage.
That's the one. The demand is just overwhelming.
Okay, so let's unpack that, because the numbers from their latest quarter, Q1 of fiscal 26, they were genuinely surprising. I mean, they showed some really powerful momentum.
They really did. The top-line revenue alone was a massive beat.
It hit, what, $2.82 billion?
$2.82 billion. That's up 27% year over year.
That's a strong number, but I also saw it was up 8% just from the prior quarter.
And that's a key detail. In a hardware business, that kind of sequential acceleration, well, it tells you the machine is running hot. They're not just recovering. They're meeting surprisingly strong demand right now.
Okay, so that's the revenue side. But, a jump in revenue can sometimes just mean you're selling more low-margin stuff. The really interesting part for me was the profitability.
Absolutely. The whole thesis really hinged on whether their margins could expand. And they delivered in a huge way.
So their non-GAAP gross margin was 43.9%.
And to put that into perspective, that is a jump of 660 basis points from the year before.
660.
Yeah.
That is not a small tweak.
Well,
for anyone at home who doesn't follow hardware margins that closely, why is a number like 44% so significant for this company?
it's significant because historically it's been really hard for them to sustain margins in that mid-40s range unless it was, an absolute peak demand cycle. Yeah. Hitting it now suggests something fundamental has changed in the product mix. They're shipping those high-capacity hard drives that are essential for AI data lakes and premium flash solutions.
The stuff that has better pricing.
The stuff with much better pricing and margins. It confirms they're selling the right higher-value products into the fastest-growing market out there.
And that favorable mix, it just turbocharged everything else. Which brings us to operating leverage. They hit a non-GAAP operating income margin of 30.4%.
Right. And operating leverage for you at home is what happens when your sales grow much, much faster than your fixed costs.
Like R&D, salaries, all that.
Exactly. So when revenue jumps 27%, but your operating expenses barely move, all that extra revenue just drops straight to the bottom line. It amplifies your profit.
And that's why their non-GAAP diluted earnings per share, the EPS, just exploded. It hit $1.78.
$1.78. That's up 137% from the prior year.
That's the inflection. I mean, that sharp move is the clearest confirmation you can get. It's not a slow grind anymore. It's a steep upward curve.
And management seems to think that curve is going to continue. They gave a very, an explicitly bullish outlook for Q2.
That's the confidence signal investors want to see. They're guiding for, what, about $2.9 billion in revenue?
Around $2.9 billion, which implies 20% year-over-year growth. And even more compelling, they think gross margins are going to expand again.
To where?
They're guiding for 44 to 45%.
Wow.
And this is critical. The CEO tied this directly to durable secular AI storage demand. This isn't just some inventory catch-up. They're framing this as a new permanent growth engine.
So if earnings are soaring, how is that translating into, a healthier balance sheet, the actual cash?
It's translating directly. Superior cash generation. In Q1 alone, they generated $672 million in cash from operations.
And what about free cash flow?
FCF.
$599 million. Let's just pause on that. Almost $600 million in free cash flow in one quarter. That's a substantial number.
It's a huge number. And FCF is so powerful because it shows you the cash the company generates after paying for everything it needs to run and grow. It means they're self-funding.
Which lowers their risk profile dramatically.
It really does. And you can see that confidence in their capital return strategy.
They raised the dividend.
They did, by a very impressive 25%, up to 12.5 cents per share.
A 25% hike.
Yeah.
That's a tangible signal. The board must believe this financial strength is not just a one-off.
Exactly. You don't commit to that unless you believe the cash engine is stable.
And I also saw they're keeping a tight lid on expenses. Operating expenses are guided to be pretty controlled. around 365 to 375 million for Q2.
Right, which is growing much slower than the top line. That discipline is what allows every extra dollar of revenue to flow so efficiently down to profit.
Okay, so that brings us to their competitive position. They're framing themselves as, I think the quote was, the backbone of the AI-driven data economy.
It's a good line.
But what's their actual moat here? Why them?
The moat is built around scale, quality, and what's called total cost of ownership, or TCO.
Okay, break down TCO for us. It can sound a bit like corporate jargon.
Sure. Think about it if you're a hyperscaler, a Google or an Amazon. You're not just buying a million hard drives. You're buying the power to run them, the cooling, the rack space, the
I
reliability.
like associated costs.
All of it. And Western Digital achieves a low TCO through superior data density, packing more storage into the same physical space. And by optimizing power and heat. So even if their drive is a little more expensive up front, if it uses less power and fails less often, the cloud provider saves millions over its life.
I see. And I'd imagine once a cloud provider qualifies those drives for their massive systems,
It creates a massive barrier to entry for rivals.
the switching costs.
The switching costs are huge. Incumbency is everything. Moving to a competitor means you have to repeat that whole exhaustive testing process. You risk failures. That friction is the moat. It locks them in.
Okay, so we have a pretty compelling fundamental story. Let's shift gears. How is the market reacting? What's the technical picture for the stock look like?
The technical setup basically confirms the fundamental story. The stock is in a clear post-turnaround uptrend.
So higher highs and higher lows.
Exactly. It's a classic bullish structure. It shows buyers are stepping in at progressively higher prices, which defines a strong, sustained trend.
But after such a sharp rally, is there still a good entry point? Or is the risk-reward getting a bit stretched here?
That's a fair question. What analysts are pointing out is a pretty constructive pattern. When a major resistance level is broken, it often flips and becomes the new support level.
The old ceiling becomes the new floor.
Precisely. So that suggests that any pullbacks to those prior levels could actually offer some attractive lower risk entry points for people who want exposure to this whole AI storage cycle.
And what about the moving averages?
Structurally sound. You have the 50-day moving average trending well above a rising 200-day. It's that classic golden cross type of configuration.
Which usually signals institutional accumulation.
It does. It tells us the long-term trend is shifting solidly upward. And momentum indicators like RSI and AKD, they look supportive. The trend doesn't seem exhausted yet.
So let's talk about who is actually doing the buying. What's the institutional versus insider flow telling us?
It's a little nuanced, but I'd say it's overwhelmingly net bullish. On the institutional side, you're seeing big, sophisticated players building positions.
Like who?
Well, for instance, Ossium initiated a pretty sizable position, over $8 million worth, and Natixis is actively growing their stake. This is the so-called smart money moving in.
But I did see some insider selling. The chief of global operations and director both sold shares. Shouldn't that be a red flag?
It's a really important question, and you have to distinguish between a warning sign and just routine activity. In the context of a huge rally and rising institutional interest, these sales look like routine diversification. These executives hold massive amounts of stock. It's normal for them to sell a small piece to manage their own personal wealth.
So the key signal is the net flow.
The key signal is the net flow, rising institutional ownership, funds buying tens of millions of dollars worth. That is a far more dominant indicator of market conviction.
That makes sense. Okay, before we wrap up, let's balance this out. What is the biggest risk here, the primary bear case?
The primary risk is, and always has been, cyclicality. Storage markets are sensitive to supply and demand, and Western Digital has, in the past, faced really sharp contractions when pricing gets volatile or cloud providers pull back on spending.
So if cloud CapEx slows down, they could get hit hard.
They could. That's the historical risk.
So what's the counter-argument now? Why might it be different this time?
The counter-argument is in the guidance. They're guiding for sustained mid-40s margins and 20% growth. That suggests the market is pricing in a normalized, higher margin structure, not a temporary peak.
Because the AI demand creates a floor that wasn't there in past cycles.
That's the thesis. It creates a stronger, more persistent base of demand.
We should also mention execution risk, right? Delivering on these aggressive roadmaps isn't easy.
It's not. It's incredibly complex, but, the fact that they've consistently beaten expectations shows management is executing extremely well. And then you have that Unconfirmed market chatter about a potential strategic move.
Right, M&A or a joint venture to unlock value between the hard drive and flash businesses.
Purely speculative, but it's out there as a potential future catalyst.
But focusing on what we know, what's the key near-term event that everyone should be watching?
It has to be the next earnings print for Q2. That's the critical test. Given the aggressive guidance they've set, investors need to see them deliver another beat and raise.
To prove that this AI-driven demand is truly durable.
Exactly. And that the margin expansion is sustainable.
So I think the overall takeaway for you is this. You have a combination of a powerful financial inflection, robust free cash flow strengthening the company, and this really strong positioning as a core provider for AI infrastructure. It creates a very favorable risk-reward setup.
Yeah, I agree. We believe the time horizon to really capture the full benefit of this AI storage cycle is probably in the 12 to 24-month range. That gives you a multi-year window to benefit, assuming, of course, that management keeps executing this well.
Don't miss out on future market analysis as we continue to track this story and others like it. Make sure you subscribe to stay informed.